Has the Fed run out of tricks to surprise the markets? Maybe so, but maybe not. That is what we are pondering here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. As ever, if you're watching this on YouTube, jump into the comments. Share your thoughts about what we're talking about, what else might be on your mind about stocks, bonds, the Fed, and we'll incorporate those into the show. The focus this week enters into the event risk portion now, because we have had the unfortunate job of trying to parse through geopolitical insanity over the weekend and how that landed with the markets. And of course, last week got a little bit of a run from the U.S. jobs report and what that all meant, which we'll dig in to here again as we did yesterday in just a moment. But now we get the calendar heating up. And the first thing that is on that calendar of note, coming to us in less than 24 hours here, minutes from September's fateful FOMC policy announcement. Fateful because really that was a key catalyst for aggressive volatility around markets. And we may have seen it turn. And now comes the question about that turn's sustainability. So what we're going to do here is look at what these minutes might have, whether they still have capacity to surprise investors, and whether they are going to let stocks and bonds have the rest of their recovery, and whether the dollar will remain under pressure or whether those turns will prove short-lived. So we start here with a look at the actual contents of the Fed policy announcement. This was the September 20th policy announcement, and the main parts of it that the market was responding to. So you hear a lot about quote unquote higher for longer rates, et cetera, but let's look at what that actually means. So here is the Fed's projection for where rates are going. And this is just a polling of Fed officials. It's not the Federal Reserve's considered collective judgment. This is everybody on the policy committee, each one of them offering a set of expectations for each one of these variables, those expectations being thrown into a single bucket, as it were, and medians coming out. So that's where we get a sense of what the committee's thinking is. It's not necessarily where they're committing to bring rates. It's where they think this is going, which of course illustrates their mindset and what they care about. So GDP expectations revised higher from 1 to 2, from 1.1 to 1.5. We'll leave 2025 and 2026 aside almost because, frankly, that's far away, and the Fed is not any more clairvoyant than the markets or anyone else. So that's a bit far for this to be immediately relevant. Unemployment rate, a little bit lower. Inflation, steady to a little bit higher. Core inflation a little bit lower this year, steady thereafter. Headline inflation a little bit higher this year, perhaps reflecting some buoyancy in oil at the time that these expectations were made, but then steady. And then the implications of all of that, so faster growth, lower unemployment, higher rates. So in particular, the rate for next year, where the onset of rate cuts is expected to occur. You can see here, we are in fact expecting rate cuts, but much more modest ones and a much longer hold before them. So whereas in June, the expectation was a come down from 5.6 to 4.6 from this year to next, now it's from 5.6 to 5.1 in this latest set of forecasts. So the Fed really right here, more than anything, is telling markets rates are going to be 50 basis points higher next year by the Fed's reckoning in September, than by their reckoning in June. In other words, 50 basis points less scope for cuts. Now, of course, the markets end up not liking this. Why? Because, again, as we return to the sort of catch-all global PMI numbers that come together out of the September PMI reporting cycle that concluded last week, we see global growth has slowed to near standstill. 50 would be standstill. We're half an index point above. So we're very near standstill if we look at the global growth picture as a whole, and we know that the market is focused on the Fed because most of the world's credit flows through the U.S. dollar. 88% of global monetary transactions are settled in terms of U.S. dollars, according to the Bank of International Settlements. And so when the Fed increases or decreases the cost of borrowing dollars, it's increasing or decreasing the cost of global credit and therefore the cost of any economic activity virtually anywhere. So, not surprisingly, the market is looking at the Fed and saying, look, global growth is near standstill. You're going to need to start cutting. And the message from the September FOMC was, no, we're going to hold out longer. We will cut, probably next year. If we look at this, we do in fact see we've gone from 5.6 to 5.1. This implies some cutting. But there will be fewer cuts than we thought. And so the market says, well, what we've learned about the Fed from this announcement is that they see global growth slowing and they're saying, yeah, but we're actually going to keep rates higher. So the thing that the markets think should beckon the Fed to ease, the Fed is very clearly saying, we're not moved. And so, not surprisingly, the markets don't enjoy that. And what you get is this very interesting response where longer-term rates go up, reflecting this sort of hold for a longer period of time. Near-term rates, the two-year yield, the one that's both liquid and sensitive to near-term policy moves, so some of the lower maturities, like the 3-month, they can be a little jumpy, and the signaling isn't very clear there. But for the 2-year, you get policy sensitivity and decent liquidity, so you can actually see what's going on. So the 2-year here holding steady, reflecting the Fed is probably done raising rates. And you can see that from the expectations as well. But at the same time, we see a surge in the term premium in Treasury markets. So it looks like the uplift at the long end is being driven by uncertainty. What does it mean that the term premium has turned positive here? It means that investors are demanding more return for lending over longer periods of time, which means they see time as a risk at this point and saying the passage of time is an independent risk just onto itself because the environment has become shaky and uncertain. So lending for a longer period, you're going to have to pay us more. That's the term premium going up. What that tells us is the market looked at the global economy, looked at the Fed, and said, right, this is not going to end very well. Because what's going to happen here has become now more uncertain. We don't know how this mix of Fed restriction for an extended period of time, and the global economy already at the doorstep of recession, how this is going to go, but it doesn't seem like it's going to be particularly conducive to stability. The next thing that happens is very interesting. The 12-month look forward on rates, which is that rolling green line there, that's where's the Fed funds rate going to be 1 year forward from any given day? That starts going down. So the Fed gives us a hawkish assessment, says the economy is going to be stronger, right? Growth is going to be faster. Unemployment rate's going to be lower. Rates are going to have to be higher. And the response from markets is, right, so 12 months forward, rates should be lower than we think. And by the way, so are inflation expectations. So we can see here the 2-year U.S. Treasury break-even rate, the inflation rate implied when you take nominal and real interest rates and you back out the inflation adjustment that gets you from nominal to real out of them. That's the bond market's 2-year inflation expectation. That's now a little bit shy of the Fed's target. It's actually dipped under, having climbed down significantly after the Fed's FOMC announcement on September the 20th of last month. Same thing with the 1-year U.S. dollar inflation swap, even shorter term inflation expectation baked into markets. So how does this comport? How is it that the Fed delivers a hawkish outcome, the market responds to it somewhat accordingly, and the result is lower future rates, lower inflation expectations? And if you look at the implied policy curve, from about the 3-month mark out, a flatter curve. So a dovish shift in the curve. In the big dotted lines there is the FOMC curve, going back to the meeting. In the small dots is a week ago, and we can see here a steady shift down in the curve, saying from 3 months to about 1 year out, 2 years out, more rate cuts, lower rates. Well, it seems to be that the market read what the Fed said and said, right, okay, so you're going to hold rates higher for longer? That's going to over-tighten. And the economic pain that you're going to create as a consequence will not only have you cutting sooner, it will have you cutting more. Because what this higher for longer through, let's say, the first half of next year will mean is cutting faster and cutting harder in the second half. And so the response from markets read from that perspective seems much more understandable. You have, once the FOMC occurs, very clearly, which, as we just saw, ballooning uncertainty reflected by rising term premium in the bond markets, and so not surprisingly, stocks go down. They go down because it is cyclically a scary thought to say we're on the precipice of global recession and the Fed won't help, or at least the help will be delayed. We can see here rate cut expectations coming in from about 2 to 1.75% as of June, coming in here to well under 1%. But what happens once this adjustment occurs? And what happens when we start bottoming here? They start to expand out again. Which seems to say, okay, the Fed spooked markets. They shifted long-term rates higher. They ballooned out the term premium in treasury markets and turned it positive. They drove down stocks. They drove up the US dollar. All of these are forms of tightening. So is it possible that the markets have already done the Fed's job for it and no further rate hikes or no protracted hold is necessary? Now that the markets have actually listened to the Fed and reacted based on what that meeting produced. And is that now already priced in? So whatever these minutes are going to say is inconsequential. Maybe, but maybe not. Because what we see now is the markets have concluded that that extra hold will be enough economic pain that the Fed actually has to speed things up. And so we now again see scope for rate cuts ballooning out a little bit here. Going from about 75 basis points now closer to 90. And not surprisingly, against that backdrop, stocks have bottomed and are attempting to head higher. The dollar has topped and is attempting to head lower. So the markets are looking at this higher for longer Fed as signaled in the September FOMC and as almost certainly is going to be echoed in these minutes, and is saying, okay, so you're going to inflict more pain on markets. That pain will make the growth situation even worse. So surely you're going to have to cut even faster and sooner than we thought before. And what that will mean will be good for stocks. It'll be good for bonds. It'll be bad for rates. It'll be bad for the dollar. And so those are the adjustments we have seen. If we look at what that looks like here, consider we now have a rate cut fully priced in for June. Right there. The cumulative chance of a rate hike before year end, which was hovering about 40% in recent weeks, is down to 28. No further hikes anywhere thereafter. The first cut in June having been almost priced into July even recently. Now we're fully baked into June, and we are fully baked for 3 cuts as opposed to 2 with a chance of 3, where we were as recently as last week before the jobs report, which, by the way, was a stronger than expected jobs report. And the conclusion seemed to be rates are going to be lower, not higher, as a consequence of this, because to the extent that data like this keeps the Fed anchored for the shorter term, the higher for longer abridged version, if you will, the more abridged it is, because the worse the pain that the Fed then has to respond to in the second half of the year. So now we're looking at 3 cuts with about a 40% chance for a 4th, and rates ending up not at 4.6 or 4.7%, where the markets thought it was going to be around the Fed announcement. And then the Fed said 5.1 and surprised on the hawkish side. Now it's closer to 4.5, 4.48 right here. So it's even lower. This creates a really interesting dynamic for these FOMC minutes because, of course, the crux of the Fed's decision to hold rates higher for longer is the labor market. And the labor market remains sticky. We just saw these latest updates for the size of the labor force, for job openings last week. And so we have updated data on this now, and we're still looking at a 3 million worker shortage as of the latest numbers. And it's just a day after the FOMC minutes that we're going to get US CPI data, which is expected to show us the headline inching a little bit down from 3.7 to 3.6, but more importantly, the core falling for a 13th consecutive month, down to 4.1. That's quite a climb down from 6.6, but labor costs remain sticky. They've climbed down less than 1%. And the Fed has long maintained that unless there is a true adjustment in the labor market to actually get these costs down, they don't feel like they're accomplishing what they need to accomplish. They don't feel like any disinflation is necessarily sustainable. The Fed obviously doesn't want to be in a place where the moment it starts cutting rates, inflation reaccelerates. No, they would like to anchor inflation at 2% as much as possible. And if we look at, again, what we're seeing here, what we're learning is that based on current rates, with the trajectory as priced at this moment, we're going to get to basically the Fed's target in 2 years' time. So what we're looking at then here is the risk that the Fed comes out and says, through these minutes, not that, of course, this represents new guidance, but of course, the Fed can shape the minutes. It's not as though they're a strict retelling of what was said. No, it's a kind of editorial summary. And the Fed is, of course, self-aware. It knows that the markets are looking at this for guidance. So the editing of the summary can be done this way or that to encourage this guidance or that guidance. The Fed recognizes that this is another instrument in policy, another way to communicate to markets and shape outcomes. So it knows what the markets have been doing since this meeting. If the minutes then give us a picture that says, yes, higher for longer, all of these things that you've already been pricing in, investors, no surprise there. But unless we see a break in the labor market, or at least we expect to see a break in the labor market, and it's a break in the labor market that would convince us to consider rate cuts. And that without that, rate cuts are probably a tough sell. Then the very aspects of this thinking that has been developing in markets recently, that has given us the rebound, will unravel. In other words, what we've seen here since the start of October, the expansion of rate cut expectations for the back half of next year, and the attendant rise in stocks, if this as a premise sounds wrong after the markets read these FOMC minutes, then this sounds wrong. And then this move right here is where we're going back to. It means the adjustment isn't quite done. It means there is more de facto tightening to do. Now, of course, the Fed is not going to be explicitly in these minutes saying we will not cut rates unless. So this is going to come down to interpretive response from investors. So it's one thing that the minutes say, it's another how the market's taken. It seems overwhelmingly likely that the minutes are going to be hawkish, and that much is probably not surprising, nor market moving anymore, because, of course, we've already been moving on what the September FOMC has wrought, and we seem to already be going the other way. The adjustment seems to have run its course, unless the bedrock expectation that the markets now run with, the sequencing expectation that higher for longer at the start of next year means lower, harder, faster in the second half of the year. If that expectation meaningfully suffers, based on whatever interpretation the markets manage to extract from these FOMC minutes, well, then we have a bit of an issue in the makeup of this risk rally. And the concerns may well put a cap on it near term. Now, of course, which way this goes and whether the markets care, we shall see. The response to non-farm payrolls on Friday was a very clear version of, here's the markets giving you the we're concerned about the Fed response for an hour, and then very demonstrably reversing and saying, okay, now we're done being worried. And despite a very robust, seemingly Fed hawk encouraging NFP number, stocks end up going higher, dollar ends up coming down, because the markets seemingly conclude at this point the adjustment is done. What the Fed was trying to signal has been signaled and absorbed. Now we can go the other way. So it could be that we have a similar outcome here. But if the fundamental hope for more rate cuts unravels, or is at least reduced to some extent, risk seems likely to suffer to some extent as well. And that is Macro Money for today. As ever, we are here every Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at tastylive, where we try to figure out with our usual co-pilot Dylan Radigan what happened in markets and what might be happening next on any given day. I'm on with Chris again for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sunday evenings, opining for the news and insights portion of tastylive.com. In fact, a summary of this very analysis is already there now. And sporadically commenting on the platform formerly known as Twitter, at @AliasPback. Thanks very much for joining. See you tomorrow.